Welcome to what I kind of figured out was about our 125th meeting of the Mergers and Acquisitions Forum. Uh, Today, we've got a really good program, I think, set out for you. I hope everybody isn't totally Zoom exhausted, but I know a lot of us are getting kind of tired of it. Mike Dahlke is going to share with us some of his experiences in oil and gas deals about acquisition, transition, and value capture. Value capture, of course, is one of the biggest things in mergers and acquisitions. You know, you buy a company for a reason, and the reason is to increase value of your own company. So we're looking forward to hearing from Mike here pretty soon. Our next meeting is going to be on the 28th of July, again via Zoom. And Carl Meyer, I think, is looking into finding us a speaker or being a speaker. So we'll have that posted on the website here as soon as we get that all straightened out.
Carl's going to be the speaker. So
he is going to be the speaker. Okay, good.
Yes. Generously
Thanks, Mike.
Volunteered after I twisted his arm.
As usual, we have our vision of helping to produce an environment that fosters transparency and trust in the M&A community and all the stakeholders therein, owners, buyers, service providers. Our original basis was in net weaving, and net weaving was the idea that leaders of companies could get together and work to make the world a better place for all. And as Theodore Roosevelt said, nobody cares how much you know until they know how much you care. And we've carried over a policy of servant leadership from that era, which means that leaders are really the servants of the followers and provide the environment for the followers to be productive and happy. So Warren Bennis, one of my favorite guys, has said in a time of drastic change, it's the leaders who inherit the future. The learned find themselves equipped to live in a world that no longer exists. So I guess the message there is don't stop learning. One of the exciting things that we've got on the horizon is we are going to have a totally redesigned M&A Forum website. And this is just a little picture of part of the homepage. You can see it's quite a bit different from the one we've been working with for the last several years. And that comes to us by courtesy of Kyle Griffin at Creative Heights. He is doing that. He and his team are doing that for us. So look for that in July. So as I mentioned, Mike is going to talk about acquisition, transition, and value capture. Mike spent a lot of time in oil and gas as a senior executive and has been through the ringer and around the block and up and down and all over the place, even down to Australia, where he has led various oil and gas organizations in trying to be successful. So we're looking forward to hearing from Mike. Mike, if you're ready, I'll just bring you on here.
I am as ready as I can be, Mr. Bob.
All righty.
Appreciate the introduction. Let me know when I'm supposed to do something here.
You are on.
Okay, so I do share screen. I do this. I'm going to share that.
And there you are.
There I am. First of all, apologies for being the mystery man on your screen. I changed my personal Zoom venue because I wanted to make sure that technical challenges didn't occur. We've had a couple on my wife's old machine before. So again, I apologize for the kind of strange lighting. I don't know quite what happened, but thanks for giving me a little bit of your time and attention today. As I said, as Bob mentioned, have been a long time participant in the oil and gas and actually in the energy business. Have been involved in the so-called midstream and the so-called downstream, where I used to sell propane to people in Latin America and transport liquid fuels around and to terminal them in the Caribbean. So the insights says oil and gas deals. I'm going to cheat a little bit and take a little bit from some of the other transactions that are oil field service related, maybe midstream related. Came across, and it just randomly as I was looking for some material for this presentation, a deal summary that I put together back, I think when I was leaving or after I left Enron 20 years ago or whatever, but I had $6.7 billion worth of deals on there. So I come at the question of M&A and the process of M&A kind of from that perspective. I consider myself as much an M&A guy, a business development guy, as I do an oil and gas guy. So,
Mike, can I just throw in a side note here real quick?
Yeah.
If you've got questions for Mike, stick them in the chat space down the bottom of your screen or wherever it appears, and we'll try to work them in, or we'll try to get to them after the end of the program.
Thank you. In any event, we'll lean on all of that experience as we kind of go through there, and also some of the color provided by a couple of the folks at McKinsey, the consulting firm, and another group out of Dallas that I think several years ago, maybe 5, I don't even, maybe more, spoke at the M&A forum, Crumblish, which is again a small consultancy up in Dallas that focuses on M&A. So going to talk about oil and gas and why oil and gas. There's a vast array of elements in the in M&A, from the perspective of from a buyer's perspective, and the backers. As Bob said, one of the utmost important elements is being able to the ability to exploit the potential for the assets or the company that you bought. It's extremely important. It's the growth we're after ultimately to build value. Prospects for maximizing the value capture really depend on effective transition. That's again speaking from experience. So that's again we're going to talk about that process really to get things organized. What works, at least again in my opinion, my view, my experience, to get things organized. And I mentioned I've leaned a little bit on McKinsey and also on Crumblish. And I want to give you probably ask why oil and gas very quickly. It's particularly a good industry, particularly what's called the upstream oil and gas. Being as we're in Houston, I think most people know upstream, but just to be clear, we're talking about leaseholds, we're talking about well bores, we're talking about tubing, we're talking about tankage, we're talking about pumpers, going about the assets that produce barrels of oil and cubic feet of gas, standard products, not fancy widgets, not different chips, but very standard products. The other thing that's very unique about the oil and gas, again, particularly on the upstream side, is that authorities, either federal, state, and sometimes local, really require that the companies, whether you're private or you're public, you have to report your results, because the federal government wants royalties, states want, and locals want taxes. And you have to be a little diligent, a little patient, but you can tie back the results that a buyer achieves with the assets or the company that they require. So that is, again, unique. It's not a lot. There are a few segments that I know about in industry where the results of production and development are so transparent. Third thing, the market determines prices. Again, you've got Cushing, Oklahoma, and you've got Henry in Louisiana for sales points for gas and oil, and you have public future market where there's a transparent pricing. Again, there's differences in location and quality and so forth, but fundamentally, you know what the acquisition from the outside, you can see what is being accomplished with the acquisition, the assets that were acquired, and you can put numbers, you can add economics, because in addition to the reporting and the market transparency, there are quite a few public companies. There are standards for disclosing costs, costs of operation, costs of development. So again, you can compare, contrast, and see exactly, did that acquisition work or did it not? You can actually track, the wells are unique, and I actually can't think of a time where the names don't change. You buy a well, it still has the same name, it still has the same number, and you can go to the Texas Railway Commission and you can follow that well until it's abandoned. And figure out what happened with that well. You can figure out what happened with that lease. Did they drill new wells? So it offers a wealth of data to consider how an acquisition and how the transition was handled and how the acquisition actually paid off. Business continuity. I think we've all probably been into the deal, and there's a lot of enthusiasm, a lot of energy, a lot of focus, and at least on one or two occasions, I've seen where the afterglow kind of shines in the light of the new owner. Now, if you're a big company, probably have a team to hand off to. But when we're talking about acquisitions that are smaller in nature, in oil and gas, that could be a $5 or $10 million asset kind of acquisition, or a $20 million small company acquisition. But as the buyer, you now become the new owner. You have to change hats very quickly and pay attention. The first rule is don't lose the value you acquired. You want to capture additional value, but the first thing to keep in mind and keep in front is don't lose the value you acquired. And that means you've got to focus very quickly on safety and security, because that's critical to business continuity. You don't want to dig a hole. Don't want to lose money. Intangible assets, you have to make sure that in your due diligence you confirm them, that you you pinpointed the appropriate risks, the key risks, and make sure now that you're on the inside, talk to the folks, understand what is keeping them awake at night. Did you identify those things in your due diligence? If not, you need to pay attention. Oil and gas, literally, in a flash, you can lose everything. You can lose your assets. You can lose your people if you're not paying attention to safety from not only day one, but moment one. So we need to make sure, and you say, well, I'm not oil and gas. Yeah, I've got a service business. Well, okay. What about food safety? If you bought a hotel, you bought a testing lab, what about contamination in the laboratory of the specimens or of the people? There are dangers that you need to be aware of, the risks you need to manage, and you need to manage them from day one. Or, as I said up top, you're going to create liabilities, you're going to lose revenue, and you're digging a hole for yourself immediately. Don't forget the people. Hopefully you've checked to make sure that any key men were contractually committed to stay with the company. But make sure, maybe read that contract again. Make sure that you have an understanding of the continued service of those key people, and also that your security keeps you away from the harmful nature. Sometimes, again, people will in fact feel put upon, feel hurt, feel abused, and they can be a source of problems, not a source of strength. So security, safety, right up front is, again, it's essential to business, and business continuity is essential to making sure you hold on to the value so you can grow it from a base. Day one, new sheriff in town syndrome. I've seen it. Had actually trouble to some extent in one of the acquisitions involved foreign assets as well as US assets. And the company at the time, the foreign assets were their first foray into offshore international oil and gas. It was not only international, it was offshore. So, the ideas of what was going to happen and what was going to make things work better proved not to fit, but it took a while to figure that out because we came in with guns blazing. We've been focusing on price, and we got the price right, we think. But the deal's closed. We got to create value now. We need to figure out what's the reality of the business. In that case, the reality of working offshore in Peru. In that case, what works. What are the realities of that compared to what we saw from, in that case, Houston looking south for the most part. And you need to be prepared to reappraise what the opportunities are. Maybe you didn't catch them all, or maybe the ones you thought were there for one reason or another have slipped away. So day one, light touch. Just, again, kind of back to safety and security, but button down the cash. Again, that was particularly tricky in that since we had international banking relations in addition to U.S. relationships and procedures that we were familiar with. Make sure that everything is buttoned down. Meet the people across the organization. Again, acquisition, especially if you're dealing with a smaller transaction, you may have only dealt with the existing owner, or you may have only dealt with a couple of the owner and a couple of his immediate reports. So find out, talk to the folks up and down the line, and figure out, particularly if you're gonna grow, figure out how they're measuring the business. as you're going in. It's patience is going to be required, but if you have the penchant for activity, like what was it, the infamous movie character Austin Powers, is a man of action. So sometimes if you're a man of action, and we had in that particular acquisition I was mentioning, we had a man of action who wanted to get things going and make hay and make a name for himself and make a bonus. So be patient a little bit at the front end. Again, move crisply. Don't show up a week or two later, but touch lightly. Get outside your head to look for the upside. You obviously did the due diligence. You think you have an idea. You do have idea, not you think. You have ideas of where the synergies are and where the value can be captured. But again, my experience, to talk about Peru, I guess, or just touch on it, but again, different culture, different, really very different approach to operation that had made the assets there very profitable. So the idea is that you wanted to import from West Texas were not exactly the ones that were going to work. So talk to the stakeholders, your customers, your employees, your suppliers. Maybe this, maybe the supplier that you're using in North Dakota, in the Bakken, to do your fracking, maybe he's not the right guy to be doing it in the Permian Basin in West Texas. So again, explore that with your employees. Maybe they have experience and they tell you that it just doesn't fit. They don't have the experience. We need to get another. Maybe your brother-in-law is not the right guy to come in and be a supplier. Well, Bob touched on net weaving, and that's listening with the intent to hear rather than to answer. Probe, ask leading questions, challenge assumptions that people have built up, the heritage assumptions that they bring to the table. Some of them may be very relevant to how you're going to capture value, as in the case of a Peruvian deal, or they may be totally off base, and you may be going down the wrong path. My reference to The Wizard of Oz: look behind the curtain, find what's hidden that perhaps you didn't see when you were doing your due diligence, focusing on price, focusing on setting a price, focusing on the leadership, whatever. Your experience can be very valuable, and so make sure that, again, you're looking through the lens, you're looking at the opportunities that others are suggesting, but infuse it with the insights that you bring to the table. Again, actually, in the case of Peru, what we found is that after a while, the acquiring management kind of backed away, and we ended up with a bit of an uncontrolled subsidiary working in water offshore Peru, which is kind of a challenge. So take it all in, rethink, make creative and informed adjustments to the plan that you had for value capture when you went to the table to close the deal. I say plan with a purpose. You need to organize and prioritize the initiatives you want to capture or to eliminate inefficiencies, to create efficiencies, to find the synergies between your existing organization, if you've got one, and the new organization, and find those value capture opportunities that are out there. And he just said, give people a challenge. They need to be challenged, but don't again start off with the notion in the case of oil and gas that you're going to double or triple production over a short period of time. That you're going to just start pumping the wells as hard as you can pump them. We had actually, that was up in Wyoming. We had a little bit of a challenge with that, kind of part of that same acquisition. That was gas, so it wasn't pumping, it was just opening up the wells. And all of a sudden you are doing damage to your assets. So make sure that you've got goals, that they're stretch, but they're not unsound technically, and so out of the realm of possibility that people just kind of give up before they get started. Revenue, again, long term is really the key. We cut costs, and very important, back to continuity, keeping the value you've got, finding the synergies, increasing your margin, but ultimately it's selling more. In the case of oil and gas, it's selling more barrels of oil or cubic feet of gas. But that's going to require an investment. Again, you got to spend money to make money. You're going to hire more people. You're not in oil and gas. Maybe you're trucking the oil and gas. You need a bigger fleet. So be prepared. Set the targets. Be sure the assets. See how much financial powder it's going to take, given the size of the target, the range that it's out there, and the speed at which it's moving. If at all possible, keep some dry powder. You're going to find risks. You're going to be surprised, and you're going to need additional money perhaps to overcome them. You're going to have unanticipated costs. Again, on the good news side, back to revenue, accelerate the scale up. It's particularly in oil and gas, you want to move perhaps quickly to get to the adjoining leases. If you've discovered in your due diligence that the old operator was not taking advantage of all of the productive zones, perhaps, and your leases next door come available, you want to capture them, you want to move quickly and scale up your, in that case, drilling and fracking operation. So if you're selling software or developing and selling software, again, if you get an advantage, you want to scale up, you want to take advantage, be that first mover, can capture the value there. So if you haven't got a large bank account, public investors, for example, or private partners that have depth in capital, then you need to think about ways of obviously developing some dry powder. And again, back to oil and gas example, sometimes we look to sell off, let's call them what you'd call them marginal producing properties. They may fit somebody else's plans very nicely. So generate cash through the sale of properties. In some cases, I'm trying to think, I don't remember that we actually did it, but one of the things we looked at on a couple occasions was dialing back. Don't drill the next 5 wells. Husband the capital, produce the wells, get the cash flow, and build up, again, I call it a reserve, but build up a fund to go and get those leases that are right next to the best properties you have, as an example. Or in the case of if you're software, buy out somebody who is creating an application that fits with your software, so you can offer a broader range. So keep the powder dry if at all. If you have some, if you don't have some, more value will be captured if you can be patient and build some funding to scale up and meet the unexpected costs and risks. So. I had a spirited conversation with one of the participants when I shared a draft of this slide. It was like 12 months is too long. Your investors want returns. If you're a public company, you got analysts that are going to be checking you every quarter. Where 12 months is, that no. It's 12 months, 1 year, kind of a bit arbitrary. But the point in my mind is that it will take time. My experience tells me it's going to take time to capture that value. So deciding, back to setting reasonable expectations, challenging but reasonable. Find a time frame that works. And maybe it's 9 months, or maybe it's, 15 months, something. But just have a time frame in mind. The near term, get started. It's not going to be perfect plan. No plan's perfect. You're going to have to make adjustments. But going in, you've got, in my view, in my experience, you've got a lot of anxiety that everybody's feeling. You're the owner and you don't know, are you the savior? Or are you a homewrecker when you come through the door? Your leadership team, hopefully you've got one along with the assets. Are they going to be handcuffed? They don't know. Or are you going to take the handcuffs off of them? Or are you going to put them in a straitjacket? Anxiety. Employees, are you a good sheriff or a bad cop? Who knows? You're an unknown quantity. Suppliers and customers, if you got a brother-in-law out there, or are you going to expand the relationships? Or are you going to displace them with that brother-in-law? Your investors, your bankers, they get that done deal afterglow, hopefully, but maybe they got lender's remorse. One way or another, you've got a lot of what I call pent-up energy. So, done the planning, set the goals, figured out the measures, to kind of skip past, but you have to be ready to measure, and you want to launch the mission, to capture value, to create the synergies, to build the efficiencies, and you need to essentially kickstart the action. There's going to be pain, so you need to face it and deal with it directly, openly. Again, I've seen circumstances where, in fact, ultimately, when Enron tried to put its disparate oil and gas businesses together, there was clear, cultural issues, among other things, and personality issues. And instead of dealing with it kind of up front, it was, they tried to create some structures, some organizational structures that kind of kept everybody happy. And of course, in the end, nobody was happy. And, we ended up kind of breaking things up. People lost some talented people in the process. So be open, be direct, obviously be kind as best that you can. But if you do it in a direct and human way, you can start the healing process, and you need to build and align the cultures. Once again, back to that example where we had the West Texas culture in that case and a New York culture. Anybody familiar with New York cultures and Texas cultures probably knows that was a challenge to weave those two disparate ways of approaching business into an effective organization. So, and again, that was hampered by not taking some of the pain right up front, but trying to see if you could balance two cultures rather than create a new culture. It was when, and I think back, it just struck me that when you brought in somebody from, in that case, you had to bring in somebody from the outside that was not part of Heritage 1 or Heritage 2 and create a culture for the new organization. And again, it probably took at least 12 months, probably more like 24 in that case. But once that culture was built and maintained, that now independent company is probably one of the most, not probably, it is one of the most respected and most profitable independent oil and gas companies really in the world. But it was a basket case for the first 2 or 3 years as it struggled, didn't take the pain, didn't build their own culture, tried to figure out a way that everybody could live together happily ever after. Just didn't work. Take the pain, build your own culture, and keep looking forward. Keep looking forward, looking forward and pressing forward. People want to slide back on the way we used to do it. It's a constant problem. So communicate progress, communicate obstacles, adjust the plan, overcome the obstacles. The obstacles are the way. In the end, measure, achieve, and celebrate. Be happy. Again, that's milestones that people can look back on, gather, and be filled with some excitement and brush away the anxiety we talked about at the top of the slide. In summary, what have I learned? Well, you need to start the value creation, patient, thoughtful, but get it going early. And once you've got the actions moving, don't lose momentum. Again, back to my experience, didn't get the culture right, momentum was lost, and there was just a year or so of just struggling. So take the pain, get going, and don't lose momentum. And that's a summary of 40 plus years of doing deals, both oil and gas and other deals. So I don't know, Bob, you got any questions?
I have one question, Mike. In the past, in integration, I've used a employee stock award program, especially on the executive level, to kind of draw everybody into the fold. Have you ever tried that?
Let's see. I have seen, at least in one circumstance, that worked real well, Bob. I was on the outside. That was a business that I sold rather than we bought in that case. It was, for Herb, it was what am I trying to think, Herb? Tell me. An employee buyout. Led by the guy who was the manager of the business. And yet he very effectively used the opportunity to give his management team And in fact, he went further, even down to the supervisors on the floor, actually a plastic manufacturing, products manufacturing operation. So, yep, that can be a good tactic. And of course, if you're a public company, you have a ready-made currency to do that with.
Okay. JB has a question. JB, why don't you just unmute yourself and ask your question?
Very good. Thank you, Mike, for this presentation. And it occurs to me that my question, oftentimes that my topic has some humorous stories attached to it.
Uh-oh.
I try you out on this. Have you ever had any experience having to rework an accounting department?
Reworking an accounting department. I was not directly involved in reworking an accounting department that comes to mind immediately, unfortunately.
Well, it has to do with the core matter here is numbers before and after, and I don't want to take away the focus on the soft issues. It all adds up, and but the numbers usually have a funny story attached to them, how they were done in the past and how they need to be done in the future.
Yeah, and I mentioned I kind of skipped past that point, and I shouldn't have, regarding the measure, developing, understanding the measures that are being used, the processes that are being used to capture that data. Again, in the oil and gas business, certainly in the last, I don't know, let's say 10 years, but the data capture process, the data analytic process has been critical in being able to achieve cost reductions and drive business processes in some years where the price of oil was cut in half or worse. So you're right, that is a key part of this transition process, is getting to know that data. Where's it coming from? What are the definitions? And what do you need to measure the progress toward the synergy goals, the cost saving goals, the value enhancing goals, revenue enhancing goals that you set in your plan? Again, you're going to have to adjust the plan. Are you spending too much money? You're going to have to know that too. So thanks for taking me back to that point.
Mike, I've got another question, if you don't mind. In the past, my experience has been that there is a lot of friction in a merger over who's going to be in charge, on the executive level and especially on the board level. Have you had that experience?
Yeah, that I was alluding to that in the situation where we acquired an oil and gas operation that was based in New York, and again, driven by a culture that was substantially different than the style and culture that ran the existing oil and gas operation we had, which was based here in Houston. And yes, again, I talked about trying to structure things. So yeah, I tried to use a board structure that was complicated. Back to your point, Bob, about giving people a piece of the action to get them aligned. In that case, the former owners of the New York-based operation got a considerable incentive to, for I guess their agreement to sell garnered them a considerable incentive, and they turned that around actually and used that as leverage to try and create a board, more of an independent board for this organization. Again, to accommodate, we tried to do that, and it was not successful. There was lots of friction, lots and lots of friction.
Yeah, I was knee deep in the merger between Burroughs Corporation and Univac back in the 80s. And their solution to that was to take every other management layer and parcel them out equally here and there. So, for instance, the Burroughs CEO got to be the new company CEO, but the CFO came from Univac, and then they alternated on down the line, even down to the local supervisors. And frankly, that was a disaster. It was, you wound up with people who were in positions they shouldn't have been in, and a lot of them didn't have the respect of their employees, and it was terrible.
I think in oil and gas, one of the highlights, I suppose, or case studies, because of the ConocoPhillips merger, so-called merger, and somebody mentioned this just the other day, but I don't know if it's still true today, but whatever, 10 years ago, and it's probably, that occurred, 30 years ago, 25 years ago. But people still would say, I'm a Conoco person, or I'm a Phillips person.
Yeah.
And you couldn't get rid of it. And as I said, in the case of our acquisition, this again was when I was with Enron, but when we bought what was known as Belco Petroleum, I think they reemerged as an independent company. But yeah, we lost 3 leaders in that whole process. They all went different directions, and it was not until Forrest Hoagland, who came in and took control of that and built, as I said, he built his own culture. He built a tremendous culture, and a culture that was actually built for the ups and downs of the oil and gas business on a major scale. And that was the key. But until then, yeah, we had the folks that leaned from New York. They were very big into the Peruvian operations offshore. And of course, we had our West Texas operations, and then they had Wyoming operations. So we had geographic differences among people, and different heritages in Peru and Wyoming and Texas, and it was a mess. So again, pain, you got to take it.
Yeah.
How are we doing for time, Bob?
We've still got a fair amount of time. If you don't mind, we'll continue with the questions, because
Sure.
Jim has one. Jim Dumler, you want to unmute yourself and ask your question, or you want me to read it?
Either way, it's fine, Bob.
Go ahead.
So, Dave, Mike, what are your insights regarding due diligence on intangible assets, and how have you found ways to retain and grow that value source?
Intangible assets from the oil and gas side are not typically an important issue. You'll see on the petrochemical side, we had a polypropylene technology that was cutting edge, that we got from Germany. And so we made an acquisition in order to, again, back to what I'll say, scale that technology up. So that, what my experience was, building that a substantial investment ultimately had to be made to to scale up that. And hence my point earlier on regarding what I call dry powder, that you need to be prepared oftentimes to follow on that initial acquisition with an investment. And again, that one instance I can think of, it was if you will, the intangible asset we had was a technology that we were able to scale up. I don't know if that addresses your question or not, but that's my experience.
Oh, that's good. Yeah, just saying, I appreciate that.
Okay.
Yeah, finding the opportunity as well as executing on it. That makes sense.
Mm-hmm.
JB, you want to go ahead?
Okay. I was wondering if maybe there's a difference now in the M&A markets, generally speaking, without the added demand from Wall Street, which is what I've been hearing about in the last 6 months.
I'm not quite sure. You're talking about the fact that there are more private deals, or that Wall Street is given up worrying about this quarter and next quarter, realizing that the virus is conking everybody on the head. Is that what you're saying?
Actually, I was referring to this this phenomenon on Wall Street that's always been with us, where everybody's worried about missing out in oil and gas, and and that's going away. So, does it do anything to valuations? Does it do anything to the players, who the players actually are, and do they have different attitudes about the integration process? Is it easier?
Let's see. Well, as far as the impact on, if you will, the quote players, the private equity, the chain of events for many folks was private equity, money backing, let's call them private or semi-private organizations, who would then go public, or they might start out as, again, quasi-public organizations or entities that would then allow the private equity backers, not that they're bad, but the cash out, the flip, and move on to the next deal. That process has not proven successful here in the last several years. So it has meant that private equity funding has backed away. Value, again, I haven't done too much on valuation lately, but some of the anecdotal things I've heard suggest valuations that we're considering. If you think about how many dollars per flowing barrel people are paying today, when they actually can get the funds to pay, and they strike me back as considerably below what we would look at when I was part of Jefferies Energy Group, and we were heavily involved in the marketing and sale of oil and gas companies. So that has had an impact. There's no doubt about it. There are assets that are working their way to market because people are unable or need to raise cash. But to me, it's been surprising that there has not been more, let's call it distressed property available, which would obviously impact value as well. Perhaps in part it's been the fact that the Federal Reserve has been, actively buying all kinds of bonds and providing credit and keeping a number of the companies that I'm familiar with are very highly leveraged, and yet they seem to be hanging in there, quite surprisingly. So,
Mike,
yes,
can I jump in? I have some more input on this.
Henry, of course you can jump in.
Thank you.
I already took your name in vain, sort of, so go ahead.
Yeah. So usually in low oil prices, historically, in low oil prices, it has been a time when there will be a lot of merger and acquisitions, and mostly by majors acquiring independent. I guess you are interested about that, correct, JB? You are interested to hear about that, correct? Okay, but this time, yes, we have the low oil price, correct, but also it was preceded by almost 2 years that oil companies in general, whether majors, super majors, or independent, that are not making the big returns and big money, all because of the shale. The shale and the horizontal fracking has been draining a lot on their resources. And you know that Wall Street for the last 2 years have not been happy about the performance of many of the energy companies. And coming now to this low energy price environment, it should have been heaven for them, but because they have not been able to perform and make good money before that, they are, it's a little bit difficult to go again into acquiring a company or a large asset and justify that to Wall Street. Wall Street, they want to see first you are able to make money, you are able to make good returns. So this is the situation now. It's really difficult. It's really complex. This oil price has added difficulty to already a difficult performance energy company for the last 2 years.
Okay, thank you, Henry. I think that's about it. I've got a couple things I'd like to talk about. Mike, if you would unshare your screen and hand the hosting back to me.
Well, I'd like to cover my final thought if I
sure,
could,
absolutely.
Before, if we've got just a second, you know, I appreciate one of the lead. That's why I was asking about timing. Usually, when we get to this, I call it a closing thought, a final thought, and it usually ends up to be an afterthought as everybody heads for the door at the Houston Exponential Center. But if you wouldn't mind keeping the cursor away from the leave meeting button for just a couple of minutes, I'd like to reflect on the thought that I offer to you today. You know, the last couple of days we've seen cases, virus cases off the charts in many places in Texas, including Texas, including Houston. It's a reminder, virus hasn't gone anywhere, folks. It hasn't gone anywhere. It lives among us. It multiplies among us. It's still killing us, killing our fellow Americans. Past couple of weeks, you know, in real time, we've seen some literally, I can only describe as shameless murders, brutal murders of a couple of black men and a black woman. I think one of the funerals is maybe going on right now as we speak. And it's a reminder that we've got systematic racism, that it's been a burden to our society for 300 years. It's hard. This morning, Starbucks announced it was introducing an Impossible sandwich from Impossible Meats, plant-based. It's a reminder that as the economies open back up, the smog is returning to the skies, crystal skies around Houston, around Seattle, around Beijing. You know, we have climate change is still with us. The pace is going to pick up for environmental and economic destruction. It slowed for a fraction of time, but it's still with us. It's going to pick up. Sound like a Debbie Downer, but turn to, we're facing these things that are impacting the lives probably that we really want for our kids and our grandkids, because this is all about the future. And I found some solace, I guess, some hope in the words from Clint Smith, who's an author, a poet, an educator, a newly minted Harvard PhD, but a very, 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 very thoughtful guy. And he points out to all of us that the world is a social construct and it can be rebuilt. This world was built and we can rebuild it. I guess my ask today is that ask everybody to consider, how you can actively participate in building, rebuilding a stronger world that's more supportive and more uplifting for everybody. So it's my final thought. I will turn the screen back over to you, Bob.
Okay, thank you. The main thing I wanted to talk about was, I think everybody got a copy of today's program slides, I hope, yesterday. If you look toward the back there, the board is working with the University of Houston Bauer College of Business to establish an annual scholarship for a worthy student down there in the especially in the mergers and acquisitions arena, somebody who is in finance or management study. We're asking our members to consider donating to that scholarship fund. It would be nice if one company would take the whole thing over. We're talking about a $2,500 scholarship, so it's not monumental. But if you donate, your name will be on the scholarship. We'll post it to the website, and you'll get all the fame and fortune and attaboys that go along with it. So everybody, please consider that. Yeah, Joe.
Hi, can I make an announcement?
Sure.
I didn't know when to chime in because I didn't know you were going to say bye, everyone, and then I would lose everyone. So I can wait till you're done.
I'm done. Go ahead.
Hi, everyone. So as you know, my company does deals with tax mitigation strategies. We also buy and sell tax credits. I know we deal with the millions in solar credits. We work with a lot of M&A firms around the country, helping their clients offset their tax liabilities when they sell with these tax credits. So my CEO wrote me an email to reach out to the M&A firms that I have been dealing with for some other tax issues via my company. But since I have you all on the phone, I thought I would just relay that to y'all. I can send out an email if you would like to find out more about these tax credits that we can sell. I could set you up on a call with my department that deals with that.
Okay.
If you got something written, Jill, this is Mike. I'd be happy to take a look at it.
Actually, it does look like you are in the witness protection program.
Sorry.
I don't know if that's really
Wait, let me get the bare bulb, Jill. See, does that help? There we go. There we go. Put me under the bare bulb.
All right. Now you look like you're in the lineup.
That's what I said. I'm under the bare bulb.
Yeah, there you go.
Rubber trench on or whatever they are on me.
Okay. Has anybody else got a vital announcement they'd like to share? If not, we'll call it a day and thank Mike for all of his insights, which I thought were very nice to hear, and it's going to change my view of the whole post-merger process to a certain extent. So thank you, Mike.
You're welcome.
So we're going to have another happy hour coming up here, I think, in about a week, no, 2.5 weeks. And we've got another monthly meeting coming up next month. So everybody sign on to our new website. Get registered for those things as soon as they pop up on the events.
Yeah, thanks to Kyle and his team for all the work on that.
Absolutely. Let's give him the clap.
Yay.
No need, but thank you. And we're hoping the website will be done pretty quickly. We're just got final tweaks and changes. So.
Okay, good. Well, listen, everybody stay safe. Hide in your closet and drink wine. Don't go out without your mask, and make some deals. Everybody take care.
Take care,
Thanks,
everyone.
Bob.
Bye.
Thank you all.
Bye.